Today's topic, tax tips for after the year end. That's right. By the time you're watching this, we've either missed year-end tax planning or we are very, very darn close to missing it. But it's okay. We still have some tax tips that you can put in play after the year is over. And some of those can even lower your tax bill still. So we're going to cover 3 topics, which kind of have some other notes built into them. So I don't want to give you a specific number of tips we're going to cover, but 3 main topics that we're going to walk through. So stay tuned. Those are all coming up next. First topic, instill your opportunity to lower your tax bill for the previous year. I was going to initially call this retirement accounts, but in reality, we can go a little bit more broad. So first up is going to be actual retirement accounts. So remember, after the year is over, up until you file your taxes, most of the time that will be your traditional April tax deadline. Some of them will give you till the year extension deadline. It just kind of depends. You do a little Google search before. But for the most part, here are the accounts you're looking at that still give you a window. Your IRA still gives you a window. Now, if you're watching this video, I'm assuming you've watched other videos, you read some of our blog posts, you're in the Wealth Kill Weekly, you know that we work with physicians. So high income earners, we usually are looking for the backdoor Roth IRA. So keep in mind, by you still being able to do your IRA contribution, that is still your window to your backdoor Roth IRA. Now, with that, if you're going after a traditional IRA contribution where you're still trying to get that deduction, you still have that window as well. Now, the other one that's open is your Roth IRA, but bring it back to what I just said about the backdoor Roth, you still have your window here. So if you're doing the backdoor Roth IRA and it's early in the new year, in this example, we're recording this in late 2023, but we're really talking about early 2024. Let's just say it's January 15th of 2024. You can still do your backdoor Roth IRA, right? You can do a 2023 IRA contribution and then convert that, roll that over to your Roth IRA. That's your backdoor Roth. Again, you still got to follow all the rules. Make sure that there was no IRA balances on 12/31. If there was, you should punt on this idea right now. It's not going to really work well this year because we're going to bring in the pro rata issue. So remember, IRA, simple IRA, and SEP IRA are your main culprits there. If you're going for a traditional IRA, a Roth IRA traditional contribution in the sense of, hey, I just want to make a contribution directly to my Roth, you still have up until you file your taxes. For my 1099 earners, we still have an open window here for 2 of our favorite accounts. One we like a little bit more than the other if you've seen some of our videos. But Solo K, still open here. SEP IRA, still open here. Remember, the Solo K has some unique rules that if you did not open it by 12/31, you got to get limited on your contributions to only the employer, not the employee contribution. So keep an eye on that. SEP will give you a little bit more flexibility there, but it's also only based on a percent of your profit, which is why the SEP is usually kind of the default answer from a lot of accountants because it's easier to open up, more straightforward on the contribution number, doesn't kind of mess in with if you got other 401ks. So I think, in my opinion, that's why we see SEPs more than Solo Ks when the accountant is saying like, hey, you still have this window to take advantage of something. So those are some retirement accounts that you can still take advantage of going backwards to still lower your tax bill for this year. And I say lower your tax bill, but remember, only traditional IRA contribution will lower your tax bill. Solo K will, SEP IRA will. Backdoor Roth, tax neutral event. For all intents and purposes, tax neutral event will not lower your tax bill. But you'll be probably pretty darn happy in the long run when you have this big bucket of completely tax-free dollars, later on in life. Some other bonus points here. Don't forget about the HSA, the health savings account. So if you had a high deductible health plan in 2023, again, recording it backwards here, right? In 2023, and it was HSA eligible, you can still make your HSA contribution. Now, if you're working with an employer and you are doing, $100 per pay or whatever the example would be, you're going to have to go directly to your HSA contribution and make a direct contribution there. Don't forget to notify your accountant, right? That's not going to show up on your pay stub. If you're a business owner, if you just have a separate HSA somewhere and you're just going to make a contribution, same rules apply. Just make sure your accountant knows that, right? But HSA is still open. And then one bonus account I'm going to throw in here is 529 plans. So college education plans. Now, it depends on what state you live in, right? Some states do use a true 12/31 cutoff, where others will give you more flexibility into your tax filing time. So keep an eye on that. make sure your state is offering state tax deductions. Now, this is a state tax deduction. Unfortunately, 529 plans are not on the federal level. They are only on the state level. And that's only if your state offers a tax deduction. Remember, not every state does. Maybe it's because your state, like here in Florida, doesn't have income taxes, so they're not going to give you a deduction. Or some states just say, hey, sorry, but we're not sorry. We don't offer a tax deduction for that. So first thing you can do for tax planning in the new year, but still looking backwards, retirement accounts, HSA, 529. Just a few to put on your radar. Next up, we're going to call it your quarterly estimate for Q4. Now, if you're sitting here watching this, you're like, what the heck is a quarterly estimate? What the heck's Q4? I'll give you some information here. Truthfully, this is probably one of the topics that made me fall in love with tax planning. I know most people saying, who the heck would fall in love with tax planning? But from our side of it, it is a big value add for our clients. It's also something that's extremely nerdy, it's extremely complicated, and it changes. So it's one of those things that just keeps my brain really involved. But Q4 estimate here, quarterly estimated payments, this is what you need to do in a few circumstances, right? You're not covering your tax bill throughout the year because your W-4 is off, or you have some form of 1099 income that, remember, 1099 income, you're not withholding any taxes, so you got to pay taxes, or you maybe had a large capital gain event and you need to add in a quarterly payment. The first two are your most common. Those are the two that we see, year in and year out with our clients. Either their W-4 is off, or they had 1099 income and they didn't know what quarterly payments were. Here is why this topic is going to get a jump in popularity in the year 2023. In years past, if you had an underpayment penalty, it was a 3% penalty because the IRS bases this off of current interest rates. Guess what it is this year? It's now 8%. So if you had an underpayment penalty in the past, it is going to be more than doubled in future years. And if you go onto your 1040, this is listed on line 38. One thing I'll note here is I am actually shocked by how many times clients have had an underpayment penalty and their accountant did not notify them. And they're almost shocked when we say, hey, you had an extra $500 or $1,000 in penalties because you underpaid. What did you do to fix that? Well, we didn't do anything yet. What do you mean fix it? How do we fix it? So main topic here is if you are on track to underpay, whether that's through your payroll because your W-4 is off, or you had 1099 income and you'd never heard of these things on quarterly payments, you still have time for your Q4 payment. That is due on January 15th. Again, I'm recording this in 2023. We're looking forward to 2024. So that would be January 15th of 2024. Now, if you're watching this for future years, it's usually right around there. You can do a quick little Google search, IRS quarterly estimated payment dates, and it's always going to be right there in mid-January. It just kind of depends on the day of the week, right? But you can still make your Q4 payment. Now, here is my caveat. Q4 will not save you. So if you were off consistently throughout the year and you didn't make a Q1, you didn't make a Q2, you didn't make a Q3, you're still going to have an underpayment penalty. You're trying to adjust for Q4 to at least help you a little bit and then ideally fix it going forward, right? Adjust your W-4 or plan for these quarterly payments. Now, what leads to an underpayment penalty? Here are the numbers. If you were under 90% of this year's tax bill, I'm going to use 100,000 because I didn't write down numbers before I started recording this, so I'm going off the top of my head right now. But if you had a $100,000 tax bill in the given year, so in this year we're talking about 2023, if you did not cover up above $90,000 of that, you were going to have an underpayment penalty, right? 90%, 100,000, 90,000. One that we like to use is called the safe harbor. If you're a client of ours, you kind of get sick of hearing this word safe harbor, but this is our easiest way to see are you on track when we're forward looking. So we analyze our clients' pay stubs twice per year, really keeping an eye on this thing, especially working with physicians, high income earners. If you're off a little bit, this number can really snowball throughout the year. So we're looking at 100% of last year's tax bill. So in this video, we're talking about 2023 taxes. So we're looking backwards to 2022. 100% of your 2022 tax bill or high income professionals in household income above 150,000, it's actually 110%. So stick with easy math with me here. So if your tax bill in 2022 was 100 grand, you need to hit 100 grand. If you're a high income earner, again, above 150, you need to be above 110,000. So safe harbor, we like a little bit better because we knew what 2022 numbers was, right? We can use that number. We can multiply it by 1.1 to get like, hey, this is what we want to be on track for to avoid underpayment. The 90% is a little bit more difficult, right? Because we don't know that exact tax bill. Now, we can get a pretty good idea, especially looking at pay stubs, looking at capital gains, stuff like that. But those are the ways to avoid underpayment penalty. So the quickest way, it's actually 2022 1040, and then it looks like 2023 should be the same 1040. It should be on line 38. It's usually right below your tax bill, and then it's off to this side here to show your underpayment penalty. And it says it right on there, underpayment penalty, line 38. Yeah, line 38. So double check that, but this is one that is missed all the time. But one way that you can help yourself now, if you're watching this video, is that Q4 estimated payment. Again, it won't save you completely, but it will help you at least take some of that penalty off there, and also your tax bill, right? You're prepaying some of your tax bill. So number 2 on the list, Q4 estimate is still actionable for you, assuming that you're watching this before January 15th. After January 15th, you have had another ship sail out on you. Last but not least, your chance to get organized, right? It's the new year or close to the new year, depending on when you're watching this. Time to get ready for your 2023 taxes. So start to get your documents organized. Start a file, right? Make sure you get the property taxes in there. You get the 1099s, the 1098Es in there. Mortgage interest is in there. Start putting everything in a nice, tidy folder. This is also really your last chance to see, should you be taking the standard deduction or can you maybe itemize, right? The main way you're going to likely itemize is homeowners. Your home, your mortgage interest is likely a big piece of that. Before, your state and local taxes, what we call the SALT tax, was likely your next best option. But for, again, most high-income professionals, that is capped at $10,000. I should say for all high-income professionals, that is capped at $10,000. So this has led to more individuals taking the standard deduction than itemizing than many years, right? This has been in play since 2018? 2018, I believe, somewhere around there. But that SALT limit at $10,000 has been a stinger if you're looking to itemize versus standard. Those are your most common ones, and the other one in there is charitable contributions. So if you're below, here's the numbers for 2023, married filing jointly, $27,700. If you're well below that, take the standard deduction. If you can get above that by itemizing, itemize. Single, $13,850. Same rules apply. Below that, take the standard. If you can get above that by itemizing. I would try to give you some charitable tax tips here, but again, if it's past 31, we've also had that ship sail on us. So look at some of our past videos, and then you can start looking towards the future on utilizing something like a donor advised fund to try to bunch some contributions together. One other item I want to put in here. If you're trying to get your best individualized deductions, your itemized deductions, I should say, and you have been working from home and you have a separate office that you do your work from, don't forget about the home office deduction. Still somewhat shocked on how often this is missed, but this is a really good one that you can take advantage of if you have a true dedicated workspace as your home office. Now, this can't be, hey, well, I send out emails from the bedroom every single night for 3 hours. It feels like it's my office. Doesn't count, right? It needs to be your actual office. Like in my example here, right? I actually have a home office that I record really all these videos from, but it's a separate detached office. It's an actual office. So perfect example of that. But even in your house, if it's a spare bedroom, if it's another bedroom in there, or if it's even, kind of a cutout nook that you're utilizing, just trying to get the square footage. But talk about this with your accountant, but don't miss that deduction. So take advantage of your time now. Get organized, get ready for filing with your accountant, with your CPA. And then if you have a chance to maybe itemize, start tracking those receipts and see if you can get above that number. And there you have it. Some tax items you can still take advantage of, even though year end has passed, whether that's some of the retirement contributions, maybe it's getting some money into that HSA, maybe a little bit of money into the 529 plan. Remember, 529 plans are a state, not a federal, unfortunately. You still have a chance to make that Q4 payment, which, again, one of my favorite tax topics because it's felt every year, right? You know your W-4, you know your withholding, whether that's on or off. Did you have that 1099 income? So if you take anything away from that section, start to fine tune that W-4. You can adjust your W-4 every single year. Heck, you can adjust it 10 times in a given year. There's no limit. And then if you have that 1099 income, getting used to paying those quarterly payments as well. And then last but not least, taking advantage of the time now to get organized, seeing if you can maybe get to the itemized deduction. But regardless, keep an eye on all those things, get things nice and tidied up here. But as always, thanks for hanging out with me for the last 15 minutes or so. If you have not subscribed, now's a great time to subscribe to the channel. Click on this little bell icon. You also get notified every time we release a new video. And some of these videos are timely, especially when it comes to tax time. So don't forget to click on the bell icon. Again, thanks for hanging out with me, and I will catch you on the next video.